Why is the Japanese yen still hovering at 160? Despite a staggering 11.7 trillion yen intervention and a rate hike to 1%, Japan's currency defense seems to be faltering. In this video, we'll uncover the reasons behind this struggle and reveal how a hidden oil shock is cornering the Bank of Japan. We'll also analyze the latest Fed projections and key technical levels traders are currently monitoring to help you navigate this volatile market. This situation is nothing short of historic. Japan is caught in a perfect storm, where conventional monetary tools are losing their effectiveness. The Ministry of Finance's unprecedented spending in May hasn't stemmed the relentless downward pressure on the yen. It's no longer just about interest rate differentials, we're facing deep-rooted vulnerabilities within the Japanese economy. The market is now left questioning whether the BOJ has any viable options as external pressures from the US and global energy markets escalate. Let's dive into the data. On June 16, the Bank of Japan raised its policy rate to 1%. This followed a staggering 11.7 trillion yen spent on intervention in May alone. Yet, almost immediately, the yen slipped back to 160 against the dollar. Meanwhile, the Fed's latest dot plot has shifted the landscape, with 9 FOMC members now projecting at least one rate hike by 2026, and a median funds rate of 3.8%. This hawkish turn from the US indicates that dollar liquidity will remain tight, continuing to exert pressure on the yen carry trade. Traders on X are currently on high alert. Analysts have identified that US dollar to Japanese yen is capped near 161, with intervention risk spiking if the pair dips below 160.50. It's crucial for traders to keep an eye on the 158.20 support line. A drop below this could trigger a swift move to 156.80. The prevailing sentiment is one of caution, as many echo the sentiment that markets don't drift, they snap, especially with significant events like the BOJ meeting and Fed balance sheet data lined up for the week ahead. Economic analysts are weighing in, noting that the Fed's potential rate hike in 2026 doesn't save the carry trade, it merely shifts the pain. While this may compress the rate differential, the tightening of global dollar liquidity is hitting risk assets hard. Some experts contend that the BOJ is being pushed into normalization faster than anticipated, not as a proactive strategy by Governor Kazuo Ueda, but as a reactive measure due to the failure of currency interventions to maintain stability at 160. The Nikkei 225 is feeling the pressure as the usual benefits of yen weakness are fading. Instead of boosting exports, it's exposing rising costs. Japan imports nearly 90% of its oil, and the weak yen is inflating these bills, squeezing corporate margins across various sectors. While some exporters may still gain, the broader market is increasingly wary of domestic inflation and its impact on consumer purchasing power. The upcoming week could see high volatility in Japanese stocks as catalysts converge. Geopolitical factors are now at the forefront of yen weakness. Any disruption in the Strait of Hormuz directly threatens Japan's energy security and import costs. When oil prices surge, the demand for dollars to cover those imports increases, further weakening the yen. This creates a vicious cycle. A weaker yen makes oil pricier in local terms, pushing the BOJ to consider even faster rate hikes to avoid an inflationary spiral. The energy market is no longer a side issue, it's central to Japanese monetary policy. For individual investors, risk management is crucial. Next week's stacked schedule, including the BOJ meeting, US jobs data, and a significant announcement from Trump, means we should expect sharp market movements rather than gradual price drift. Keep a close watch on the US 10-year yield. If US data starts to weaken, the narrative supporting the yen's weakness could quickly unravel. Now isn't the time to over-leverage and carry trades, as the pain is shifting and the BOJ faces mounting pressure to act decisively. Looking ahead, we can outline 3 potential scenarios. In our base case, the yen stays under pressure near 160 as the BOJ's 1% rate is countered by high oil costs and Fed hawkishness. In a bearish scenario, a geopolitical shock in the Hormuz Strait could send oil prices soaring, prompting an emergency BOJ rate hike that destabilizes the Nikkei. Conversely, a bullish scenario for the yen hinges on a significant softening of US data, leading the Fed to reconsider its 2026 hike projections and allowing the 158.20 support level to break, potentially driving the yen toward the 150 range. In summary, the 11.7 trillion yen intervention has failed to maintain the 160 level. Oil import costs are now a critical factor influencing BOJ policy normalization. Keep an eye on 161 as a ceiling and 158.20 as a key support level. Brace for a catalyst-packed week ahead. If you found this deep dive insightful, please subscribe and hit the like button. We want to hear from you. Do you think the BOJ will hike rates again soon?